Whoa, Nelly, what a day we had in the US stock market. It was particularly impressive given that we had just sold off for the last few days, and it was making you wonder if the bears were going to start taking control again. But today, we had a solid advance for the bulls, not just in the stock market, but also in Bitcoin, in junk bonds, in gold, in so many different asset classes that were out there. So the bulls are alive and well at the moment. We had 77% of stocks within the market close in the green today, but I did manage to find one that fell about 1.7% within the financial industry that I wanted to focus on as tonight's trade application example, where I wanted to show you how to do a short sale technique. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's April 13th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. Remember, at the bottom of those emails, you'll also find which stocks in the S&P 500 might be giving you overbought or oversold cluster signals. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me. My handle is @BrandonVanZ. We really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's jump into today's trade activity. And as we pull up our S&P 500 heat map here, you can see it was a glorious day for the bulls. We were up over 1% easily here today, and it was a broad-based advance with most sectors and industries participating here today. We've had a few of those days here in the last month or so where it kind of felt like it was mostly a mega cap tech story. Today did not feel that way to me. Today felt much more broad-based. We had great participation pretty much across the board. We did have a few of the laggards, but fortunately the laggards were in the right places. And what I mean by that is you'll notice kind of down below here in the lower right-hand corner, the utilities seem to struggle a little bit here today, as did real estate. But of course, those are kind of your interest rate sensitive areas and are considered a little bit more defensive with their characteristics. And therefore, if we had to pick and choose which of the sectors to kind of leave out of the rally here today, they would be near the top of your list if you still wanted to remain bullish within this market. So, much better to have the utilities and REITs out of favor on a day like this than, let's say, technology and communications. So, other than that, it was pretty green across the board. You had a little bit of spottiness here and there, as you do on most days. For instance, here you see a few of those industrials showing up in the red, like Union Pacific and Parker Hannifin. You had a few of the consumer staples showing up in the red, but mostly the smaller players like Hormel and Kellogg, they were down. But our bigger players like Costco and Pepsi, Coca-Cola, Procter & Gamble, they all closed in the green here today, so that was nice. And then you had a smattering of financials doing poorly. In fact, today's worst performer was Progressive. Sadly, we do own that one in one of my trading classes, not my investing classes, but our trend trading class had a position in that one, and sadly it was down 6% today. It was our worst performer in the S&P 500. But fortunately, that's the same class account that also owns Apple, which was up 3% today, Microsoft, which was up over 2% today, and Alphabet, which was up nearly 3% today as well. So anyway, we made out just fine. But sometimes it's a little unfortunate when you see that you've got the loser in your account. So if you've ever felt that way, know that you're not alone. It happens to the best of us. The good news is the bullishness offset the bearishness pretty much across the board, as long as you were positioned in a kind of a normal distribution as opposed to just concentrated, let's say, only on the utilities or something like that. In terms of who the biggest winners were today, the one that catches my eye probably the most right out of the gate is Amazon. It might not have been the biggest winner in the market today. In fact, I think there were a couple of semiconductor companies associated with solar energy, Enphase and Solar Edge, that were up more than that. But obviously, you look at the size of the square of Amazon here, and then you compare them to Enphase and Solar Edge down here, and we're talking about two different ball games here. Amazon is kind of in a league of its own. alongside those six other, big time players that, have market caps close to that $1 trillion level. And so Amazon is much, much more important than, the bigger moves out of Enphase and solar energy on the overall result of the S&P 500 today. So Amazon had a great day, up 4.67%. What's nice about that as well is that they suffered yesterday. They had a pretty tough day yesterday, and they came right down to the 30-day moving average and kind of rested there for the briefest of times, and then responded and snapped back right away the very next day, pretty much the way that you would want to see it. So I think the technical analysis on Amazon looks a little bit better here all of a sudden as well. In addition to Amazon having a great day with that bright green color, you'll also notice that another important player would be Netflix. It's not nearly as big as Amazon, but still an important company with a market cap of $154 billion these days. It was up about 4.58% today. So right there in that same general vicinity in terms of percentage move higher. Tesla also had a very good day, up about 3%. Kathy Wood probably had a smile on her face today, not only because of that, but some of you might have seen the CRISPR stocks as well. We were talking about those a little bit in my class earlier today. Some good news in that more speculative biotech-oriented area as well. So those are the types of companies that Kathy Wood usually has in her funds. And so she probably had a pretty good day, all things considered, here today, as the chase was on, the price chase across the board. You can see that Vertex, by the way, alongside of CRISPR, had a reasonable day. It was up over 2% there, but they're kind of a partner in one of those drugs that had some good news come out on it today. In terms of some of the other areas, I would point out McDonald's here. In fact, some of you might have seen I was just posting about McDonald's here a moment ago on Twitter and talking about what an extraordinary 20-year chart McDonald's has. It looks like it is a tech stock or an internet darling or something like that, or some sort of a disruptive company that's changing the world. And all they're doing is pretty much the same thing they were doing 40 years ago, which is serving up burgers and fries, right? And they're doing it at a much bigger scale, admittedly, but in that particular case, it's the lack of disruption that has led to tremendous success for them as they are hitting all-time highs today, similar to Vertex, both McDonald's and Vertex, not just hitting 52-week highs, but all-time highs here today. McDonald's, is one of those memorable purchases that we had in my dividend growth investing class back in March of 2020. It was tremendously out of favor, as were many discretionary stocks in March of 2020. But my students did not hesitate and decided to imbibe upon what McDonald's shares were serving up at the time, and it has been a really, really nice investment for us. So love to see that one continuing to rocket to the upside. Other stocks that catch my eye, in terms of bigger squares out there, Johnson & Johnson, Eli Lilly were both up over 1% today. United Healthcare basically up 1% when it was all said and done. Disney had a good day. It was up about 3% today. Meta/Facebook was up about 3% today. Visa was up over 2% today. Chevron was up over 1% today. Berkshire Hathaway was up over 1% today. I could keep going. So the point is, we had a masterful day to the upside, and I think we are trading at our highest levels on the S&P 500 since going back to February 15th. So basically sitting right around 2-month highs at this point. So things are revving up to the upside after kind of sitting out the last couple of days with nominal losses. Today was an aggressive up day, and that bodes well for bullishness out there. All right, let's go ahead and see what the actual breadth of numbers were. Over here on the main part of the platform, I'm on the Market Watch tab, Visualize sub-tab, and then the drop down here with the Index Watch, I'm using the S&P 500. And you can see that out of the 500 stocks in the S&P 500, 387 of them were in the green here today. So again, a very broad-based advance. That's 77% of market components closing higher today to support more than a 1% move up on the S&P 500. looking at some of our charts now. Anytime we have a move of over 1%, either up or down, I like to start the conversation here on this chart 6D to give us a different visual sense to see how volatile or lack of volatility we've had here more recently. And you can see that the green bar here today on the S&P 500 does easily stretch up and over this blue bar, which represents this blue horizontal line here represents the 1% plus move. Obviously, the blue line underneath the black line there would be a 1% drop. And what's interesting about this is we've now had 1, 2, 3 days where we've been up more than 1% in the last few weeks, and 0 of those days have we had the market down that much. And so, again, a sense that the bulls are taking control of this market at the moment. I mentioned to you guys on last Thursday before I was away over the weekend with a little family getaway as a result of my son being on his spring break from his school right now. And so I'm getting this video tonight done a little bit later than normal since he was at home with me today working, and my wife just got home here not too long ago. So I wanted to kind of hand off the baton to her, so to speak, and make sure he was in good hands there. So apologies for getting this video out a little bit later than I normally do here tonight. But we had an excellent time over the weekend, enjoyed our mini break there, and appreciate you guys' flexibility as well since I wasn't able to do the video there on Tuesday. But anyway, the last time I was with you was on Thursday last week. And remember, we were kind of counting out how many days it had been since we had at least a 1% drop in the market. And I think it was something like 11 days. Well, we still haven't had a 1% drop even since then. So that number continues to grow as time goes on. Basically, the last time we've had a 1% drop in the S&P 500 was on March 22nd on this candle right here that I'm pointing at, or this bar that I'm pointing at. And so if we look up above, since that day, we've had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 days now since we've had a 1% pullback in the market. That's not asking for a lot, and that is not normal, by the way. Remember on Thursday when I was with you, I showed you a couple of other instances. They were both last year. So even with just 11 days without a 1% pullback, we had not experienced that in calendar year 2023 yet. We did see one where it was 11 days back here in, I think it was November. And then we saw another one right here with 12 days in October. But I would have to go back and do a little bit of looking. There looks like there's a bit of a gap right between here and here back in August of last year when the market was kind of, going up at a nice brisk pace at that time before a pretty healthy give back. So maybe we can count those out real quick. Let me zoom in so it's a little bit easier for me to spot. So again, I'm counting the days between this bar right here where we went down 1%, and that would have been July 26th, and then this bar over here on August 19th. And so we had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17 days during that time period. So we're approaching what we accomplished during that particular time period. But other than that, that was the only other time in the last 52 weeks, the last calendar year, that we've had a stretch as long as we are in right now where we have not had even a 1% pullback in price of the S&P 500. So if it's felt really calm here lately, it's because it should. This is not normal, what we've been experiencing here lately. Usually you get, days here or there thrown in where you have a 1% down move or a 2% down move. Every so often, even 3% down moves, like right back here and here and here. Well, we haven't had anything remotely close to that here recently. The big moves we've had have been big moves to the upside. So, I think that's a sign that the bulls are feeling more confident here all of a sudden. Whether there's going to be a rug pull, anybody's guess. But what we do know is that fear appears to be leaving the system. We know that because down below here, when we look at the VIX, you can see that the VIX has now dropped to 17. And this is the lowest level on the VIX over the last year. You're looking at it right now. There's still a lot of people that think we are in the midst of a violent upheaval in the market, yet the evidence tells you the exact opposite. It tells you this is the calmest the market has been. And the professionals that are putting money into the options market are not particularly concerned, at least given this basic view of it. Obviously, there's a million different ways you can slice and dice it. But there are people out there that are convinced we're in a recession right now and the economy is in the toilet and we're heading for disaster and everybody in the stock market that's sending prices higher is wrong and all these things. Well, the evidence is in front of us, and what the evidence is currently telling us is that the bulls are in control of this market right now. The VIX would not be at 17, literally at 1-year lows, if that was not the case. So, doesn't guarantee that will always be the situation moving forward from this point. It just simply means you have to recognize the truth of this moment in time right now if you believe that price is truth. So I find that to be kind of fascinating as well, because it feels to me nobody wants to believe in this rally. It feels like one of the more hated rallies of all time, where they will drag talking head after talking head onto business television, and vast majority of people are bearish in the market right now. Yet the markets just continue to grind higher. So it's been interesting to say the least. I have my own personal hesitation, so I would throw myself into that category where my mind is telling me, we probably have it better than we deserve at the moment. But I also have to acknowledge the truth. The truth is price has gone up very, very nicely here over the last 3 weeks. And if one party is in control, either the bulls or the bears, it's the bulls that are in control right now. All right, let's take a look here at our 4 grid. As we pull up chart 4B, you can see that this is the 4 major U.S. equity indices, and the background colors of these charts will tell you whether we have a bullish or bearish posture according to the market forecast technical indicator. And so at this moment, we do have bullish postures across the board. And again, for people who have been trying to fight this market here in recent weeks, it has not been, a very wise decision. Now, obviously, things could have worked out differently, but one thing that's nice about having a system the way that we do is that it prevents us from getting too far off course when our mind or our gut is telling us one thing, but our eyes are seeing something different. And when it comes to the market forecast, you can see here that on this day, on March 16th, so that would have been pretty much right after kind of the worst news of the banking crisis with Silicon Valley Bank and all that, we had a very nice day there on March 16th. That day was a bit of a game changer. It was that day where the posture went from strongly bearish to weakly bullish. And since that day, again, that was March 16th, basically an entire month has passed since then. We've been bullish every single one of those days, with the exception of one kind of oddball head fake there on March 28th. You had one day where the posture switched back to bearish just because of a little bit of a wear and tear on the chart. But other than that, every single day for the last pretty much month, we would have had bullish posture on the S&P 500 according to the market forecast technical indicator. And it's not alone on the S&P 500. The same thing would have been said here on the NASDAQ, only more pronounced. And the reason I say that is it was also March 16th that we went from a strongly bearish posture to a weakly bullish posture. And we did have one head fake there as well on the exact same day on March 28th. But the difference between the NASDAQ and the S&P 500 is the NASDAQ only went to a weekly bearish posture because the green line was already way up here, nearly entering into the upper reversal zone. With the S&P 500 at that time, it was just slightly below the 50th percentile. So the NASDAQ has been our leader for quite some time. This is not new information, and we've repeated it regularly, or at least I have during these presentations, and I have no doubt that David has been as well, that the NASDAQ is the leader of this market at this time. So pretty much every trading day for the last month, with the exception of one single random day. All of the others were bullish on those two indices. With the Russell 2000, it's a little bit of a different conversation. And that's the chart in the lower right-hand corner here. And the reason for that is they got hit a lot worse by the regional banking crisis than some of these other indices. And the one area that really has not responded favorably to the upside so far is the financials. And maybe it's just going to be a delayed reaction, who knows? Or maybe the banks are telling us something that is going to drag down the rest of the market. It's hard to say, of course, in real time. But what we do know factually is that the Russell 2000 has not been able to keep up with those mega cap and large cap indices up there, largely due to their impact from the regional banks. So you'll notice that the Russell 2000, as of yesterday, does have a weekly bullish posture, but it is not strongly bullish the way that the other three are, and the other three have been for well over a week, in fact, over 2 weeks in some of the cases. So that's another way to kind of identify that. Like if we were to look at only this day, like this day from March 16th onward. So I'm just going to zoom in on that day there. I'm going to do the same thing on March 16th. Where was it? That would be this candle right here on the Dow. March 16th down here on the NASDAQ is there. And then March 16th onwards on the Russell 2000 would be from right there to right there. And as you look at those charts, one of them should look different to you from a variety of reasons. First of all, when you look at these other three charts, they all have not only a dark green background color here currently, telling us that we have a strongly bullish posture on the market forecast, but all three of them also have green 30-day moving averages, which in this case means price is above a rising 30-day moving average, which is oftentimes a bullish feature to a market. Notice that the Russell 2000 does not. First of all, it has a light green background color, not dark green, telling us that, yes, we have a weekly bullish posture, but it's not strongly bullish yet. That green line down below would need to get up and over 50. And it's still quite a long ways away from that at 34. So it's got work to do. It would be very unlikely that that would be resolved tomorrow. It's probably going to take at least next week before we can see that evidence, if that is what is in store for us. But in addition to that, notice the color of the moving average on the Russell 2000 is yellow. And so in that particular case, that means that price is above a falling moving average here. So yellow is more kind of cautionary if you think of like a traditional traffic light, with green being good or go, and red being stop or bad, then yellow is kind of yield to traffic, right? Because there's more hesitation there. And that's where we're at right now in the Russell 2000. We've got progress. Price is now above the moving average, but the moving average itself continues to fall. So kind of conflicting signals at this moment, which tells us this is the one that is out of favor at this moment in time compared to those others that are out there. Now, in terms of today's rally, it was a free-for-all across the board. You were getting good activity all over the place. The S&P 500 was up 1.33%. The Dow Jones Industrial Average was up 1.14%. The NASDAQ Composite was the leader today, up 1.99%. And the Russell 2000 also had a pretty productive day, up 1.3%. So, I think that's a good sign there as well, that it wasn't just a large cap story today. The small caps did participate. You might have wanted a little bit more out of them because they're kind of trying to play catch up. But, in this type of market, beggars can't be choosers. You got to take what you're given. And at this moment, the Russell 2000 is just kind of languishing compared to the others. But we don't want to take away from a solid performance today. I think most people would be quite happy on days when their portfolio is up 1.3%, like the entire Russell 2000 was here today. So really strong activity. The bulls still control the tone, the temperament, the sentiment, the activity of the market at this moment, despite how many people don't want to believe in the story at this moment. So things can change on a dime. That's why we do these videos as often as we do. But at this moment, the bulls control the activity. Let's go ahead and take a quick peek here at our 3 green arrows chart. This will be chart 4D for those of you following along at home. And we are in a position right now where 3 out of our 4 charts do have a 3 green arrow signal. That would be the S&P 500 in the upper left, the Dow Jones in the upper right, and then the Russell 2000 in the lower right. Oddly enough, despite the outperformance of the NASDAQ, it's the only one right now that does not have a 3 green arrows signal. It still has a red arrow on the MACD histogram, but you can see that after today's nice move back higher, this bar, so let me right click so you guys can see this a little bit better. This bar down below here did not continue with more red. In other words, the way that this think script is designed is when those bars stretch lower, which is more bearish, each consecutive day lower creates that red color, kind of like back here in February where it was red, 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 and then it went to gray, went back to red, and then this gray started telling us about it rounding the corner and starting heading back up and more bullish once again. And that's what we have at the moment here for the NASDAQ composite. It gave us a red arrow 2 days ago. It continued with that negative momentum yesterday, and it probably deserved to. You'll see that candle up above there was a pretty aggressive selling day there for the NASDAQ. But today, it completely offset that. It eliminated all of the selling of the last 3 days. You've actually had 3 days in a row to the downside on the NASDAQ. That one was just barely, but still down just a touch that day from close to close. So you've had a 3-day sell-off ending with a bang for the bulls. Today's activity, one fell swoop, overtook all of the bearishness of those 3 candles. So that does a lot for a momentum indicator like the MACD histogram, and you can see that we've now started to round that corner into a gray bar, and it really wouldn't take much to get us back to a green arrow on the NASDAQ composite. My guess would be if we can manage to break out above this high from March 31st, then we will get that green arrow back right there. And that's not that far away. Heck, we could have a good day tomorrow, and it could very well do that. And remember, if we're taking out that high, we're within a stone's throw of taking out multi-month highs on the NASDAQ composite. Up there at 12,269 is where it had its intraday high back there on February 2nd. So that could also happen tomorrow, right? If we get another day like we had today, where this is up 2%, we could very well be talking about multi-month highs. So, don't discount that possibility. This is a hated rally right now, and sometimes that's the fuel for the fire, right? When too many people are short within the market and they're all scurrying for the exits at the same time in order to flatten their positions, they've got to buy back their shorts. That creates demand for the stock, which in turn creates a situation where price needs to react higher. And so sometimes those short covering rallies can be kind of exciting to the upside for that reason. All right, let's go ahead and pop on over here to the internet. I always like to get a chance to say thank you to those of you that help support these presentations. Also, by the way, here's that McDonald's chart I was referencing earlier in the presentation when I said that this chart looks like an internet stock or a tech stock or something like that. When you pull up a 20-year chart on McDonald's, it is extraordinary to see the success of that dividend aristocrat here over the last several years, and all-time highs today for the biggest fast food company out there, or at least publicly traded one. Technically, Subway actually has more locations across the globe than McDonald's, but Subway is not publicly traded. Anyway, let's do some shout outs here because you guys stepped up to the plate as you often do. As I always say, as long as we're up and over 100 likes, it gives me the impression that it's worth my time to do these free videos for you guys. And you guys did not disappoint with 130 of you saying that, yes, Brandon, we want you to continue to do these. They positively impact us. And so let's do some shout outs here and say thank you to Brandon Walker. Thank you to Trunk. Thank you to Doug and Nietzsche and Arth and Dana and George and Franklin and Peggy and Julie and Kevin and Lena and Lucius and David and Michael and Fathy and Roger and Ash and Neil, DGI and Options Daily, Dave, Vernon, Mercy, Prickly Trader, Little Rockies, Elena, etc., etc. I can't get to all of you, but I appreciate all of you nonetheless. Please keep that up, and we'll do our best to continue to put the time and energy into creating these free videos here for you. Also, let's have a little chat here about some of the information that we post over on our website. We had another great day of classes here today. I taught my question and answer session where we had a number of topics about the banking industry and about gold and Bitcoin, about exit rules for dividend growth investors. Lots of great content there for those of you that are premium members that want to check out the recording if you didn't get a chance to attend the class live. And of course, David taught his portfolio management with ETFs class as well. Tomorrow he'll be back in action with his technical analysis class, which should be a good one there as well. Let's talk about our factor selector. Remember that this gets put together based upon Tuesday's closing information, and we do review it first thing in the morning on Wednesday morning in my factor-based swing trading class, and then it's another day or so stale by the time I show it here in the free video on Thursdays, assuming that we're doing a full-length video. Remember, when we do a 15-minute version of the video and we have less than 100 likes, then we just don't have the time to review the factor selector or sector selector or things like that. So anyway, since we have the time tonight, let's go ahead and see what we can learn. Well, for the 6th straight week, we have quality leading the way from a factor perspective. And it's kind of the same story that I've been sharing with you guys over that full, month and a half time period where they've been kind of dominating. Right now, quality is closely linked to technology. Both Microsoft and Apple have a couple of the greatest balance sheets on planet Earth. They are some of the greatest business models on planet Earth, and therefore you'll find a big smattering of Apple and Microsoft in the quality ETFs. And so when those companies are doing well, there's a pretty decent chance that quality from a broader factor perspective is also doing well. Remember that Johnson & Johnson is also a poster child of the quality factor, and for a while it was out of favor earlier this year. But of course we received that really good news last week, at least if you're a Johnson & Johnson shareholder, that they appear to be on the verge of settling some important lawsuits, and that stock rebounded in kind and had a nice little move back higher once again. So even Johnson & Johnson is helping support quality factor alongside of Apple and Microsoft. Low volatility remained number 2 for the 5th straight week. They have benefited from falling interest rates, as there's a lot of interest rate sensitive areas in there like utilities, REITs, consumer staples, healthcare. Now remember, that did not include any of today's activity. So with utilities and REITs struggling today, that might have an impact on the rankings next week. We'll have to see. Remember, one day does not make a trend, but it is at least something that we want to keep our eye on. Momentum held the number 3 position. So for those that are willing to chase price, they've been benefiting a little bit more so here more recently compared to the woes that were suffered with price chasing in 2022. Dividend yield finally got off the mat. And I can tell that even in our own class accounts and my own personal accounts and things like that, things have firmed up here nicely in the last, let's call it week or two, compared to what was going on a little bit earlier in the year. And then low size did drop another notch, likely due to their exposure to the regional banks and that particular area having a struggle to kind of keep up with the rest of the market. And then value is somewhat of the same story. Remember, there's a lot of financial companies in the value category, and they're struggling on a relative basis for the same reason. All right, let's go ahead and get on back to our charts, and let's do some 12 grid analysis. Starting with chart 5A, which is our asset class 12 grid. As you can see here, we do have more green charts on the board than pink charts. A reminder that on these 12 grids, the green charts are the ones that have the bullish intermediate postures according to the market forecast. The ones that are pink are the ones that have bearish intermediate postures here currently. And I think where I want to start today is where I often start, which is in the bottom two corners, because that really drives a lot of activity elsewhere. Let's start with the US dollar here today. That's in our lower left-hand corner, and it just cannot get out of its own way. It's been quite interesting, to say the least. We talked about the US dollar a little bit today in our conversation about gold in our question and answer session. But as you can see, the US dollar suffered yet another difficult day. It was down 0.5%. Remember, that's a big move in the currency markets, especially when we're talking about the most liquid currency on planet Earth in the US dollar. This is, of course, the dollar versus a basket of other securities, but does give us a general sense of direction. And it has been pretty ugly for the US dollar here recently. In fact, after today's 0.5% drop, we're back to an oversold cluster signal once again. And remember, we were just there maybe a week and a half or 2 weeks ago on this candle on April 4th, where we also plotted an oversold cluster signal, which did lead to a 3-day rally. So could we have one of those in store for us here? It's entirely possible. Things have gotten pretty violent all of a sudden once again. But you'll notice that the flip side of a weak dollar is a surge in gold. So as the dollar has fallen now for 3 days in a row, gold has rallied for 3 days in a row. And now all of a sudden here, gold is at multi-month highs once again. It was up 1.35% here today. If I right click on that chart and maximize that sell, we could go back beyond 3 months here. And let's see if we're at a 6-month high. We are. Let's see if we're at a 1-year high. We are. And if we go back to, let's say, a 5-year high, we're not quite there. You can see that there were a couple of other instances, in particular this time right here in March of 2022, so just over a year ago, and then also back here in August of 2020, where we could have some overhead resistance. There's a lot of momentum behind this move, so I would not be shocked to see us take those areas out. But beyond that, you know, it's blue skies up there, right? We have, if we can get through those 2 points, every single person who's ever bought an ounce of gold would be making money at that point. There would be no natural sellers that would be trying to get out at break even. And that's really saying something about a security like gold. In fact, we had that conversation today as well, comparing Bitcoin and gold and some of the pros and cons. And, you know, of course, Bitcoin does not have a long history, so that way we can't really compare it to prior recessions and different, you know, inflationary periods and different things like that. But gold, we can. Gold, of course, has been around as an asset class for thousands of years. And it's a really powerful statement to say, you know, any person in the history of the world that's ever bought an ounce of gold would be making money on that decision had they held it until today. Now, on an inflation-adjusted basis, that might not always be the case, but on a nominal basis, that would be. So that would be a pretty powerful statement, and I think it's entirely possible that that occurs this year. You know, does it happen in a straight line right now? That's, you know, that's asking for a bit much, simply because we do have that oversold cluster signal on the dollar. So if we expect, you know, some sort of a bounce back reversion to the mean on the dollar, that will likely mean some selling pressure there in gold. So it's probably not going to happen right here, right now. But I think that there's enough momentum behind that asset class where we could easily be looking at all-time highs in gold at some point during 2023. So let's keep our eye on that possibility. We did see that oil was down a touch here today, but oil's been on a tremendous run as well. Their chart looks quite a bit different than gold, but they've both been heading in the same direction, which is higher. And after a really massive move, you know, from the lows here in mid-March to where we kind of tapped out here yesterday, you know, that was a very aggressive low to high move there. We basically went from multi-month lows to multi-month highs in a straight line. So, you know, I don't think we can blame it for taking a day off here. Also, keep in mind that just yesterday, oil had an overbought cluster signal. So this could be part of the start of that move where it needs a little bit of a reversion to the mean in the opposite direction and then stabilize and then see if it can make another gun for the upside. In terms of Bitcoin itself, off on the right-hand side here in the middle rung, you can see Bitcoin also continues to impress. It's up 53% in the last 3 months. No, that is not a mistake. It has been an explosive move out of Bitcoin. And so Bitcoin finds itself above 30,000 here all of a sudden. Remember, we were having that conversation during this period of time where it kind of felt to me, at least, like I was saying, yeah, we're still right there at 28,000, and it kind of felt like we were just, treading water at that moment, or we were just tracking time. We weren't really making any progress there. But over the last week, that's changed. We've had a big move from 28,000 up above 30,000 at this point, and that's a good sign for risk appetite, right? That's kind of a higher alpha bet on tech stocks is the way that you might think about Bitcoin. And so those that have pushed into that alternative asset class have had a smile on their face so far in 2023 after what was a pretty ugly 2022. Down below in the lower right-hand corner is the 10-year Treasury yield, and it was up today, so that probably explains why utilities and REITs suffered a little bit here today. But we ended at 3.45% on the 10-year Treasury yield. It wasn't enough of an advance to change the posture. It remains strongly bearish at this point, but I'm going to guess it probably wouldn't take much more to change that to weekly bullish. And the reason for that is this is not the first day of its advance. It's actually been advancing here for 4 out of the last 5 days after having these two oversold cluster signals. So I don't know how much of an advance it can get up and through that moving average. I think that would be a big challenge of it. But I do think that there's enough wiggle room between where we're at right now and the moving average, that air pocket, that it can advance into where it can change the background color of the chart to light green. So wouldn't be surprised at all if that were the case as soon as early next week on that one. But when Treasury yields are up as they were today, oftentimes Treasury bonds themselves are down, and that is what we experienced today. TLT was down 0.79%. It has a weekly bearish posture but remains above a rising moving average, so kind of just tracking sideways on that one. Perhaps an interesting iron condor candidate. Interestingly enough, we did have high yield bonds advancing today. So while foreign bonds were basically flat, high yield bonds had a reasonably good day, up 0.68%. And again, that's another good sign for risk appetite. Just like having Bitcoin up today and having, the emerging markets beating the US markets today, and having tech stocks beating utility stocks and all these other things that we talk about, those are bullish things in general, right? It is a taking the temperature of risk appetite, and that's a good sign when high yield bonds outperform government bonds. They are riskier, and when they go up and less risky securities go down or can't keep up, that's generally a sign that the market participants are pushing into more of a price chasing mindset, which can really get the juices flowing for the whole market and can be kind of an avalanche to the upside for bulls. And so one thing that we're definitely going to want to keep our eye on there. You can see up at the top, as I mentioned before, emerging market stocks outperformed the U.S. market today. They were up 1.37%. The developed foreign stocks were pretty much in line with the U.S. move today. They were up just slightly under the U.S. move, 1.28%, but still a very good day. And when you look at those two charts, you can see that EEM has a lot of catch-up, whereas the developed foreign stocks are already breaking out to multi-month highs, right? You can't even make that claim in the United States. But when you look at EFA, that's a big move that they've just had. Here's that chart where you can see it a little bit better, and you can see that these last 3 days that we've had here, so basically Tuesday, Wednesday, Thursday, have allowed EFA to break out to new highs. And remember, EFA basically tracks some of the developed foreign countries, especially those in Europe, Australia, Japan. Of course, Buffett was on TV yesterday talking about his investment in Japan that he's had for a while now, and seems to enjoy his experience there to the point where he's traveling over to Japan for interviews as a 92-year-old. So maybe that bodes well for Japan. I've talked in this class or in this presentation in the past about a stock like Novo Nordisk, which is a company that we own in my top-down trend trading class, and that stock is just explosive to the upside. So those are some of those Scandinavian countries there in Europe, and there's a number of other, very nice situations out there. Some of you saw me retweeting something this morning on Louis Vuitton and why the CEO or the founder of that company is the richest person on the planet at the moment. And of course, that's a big European conglomerate as well. So, don't discount the possibility that we need to see some changing of the hands where the U.S. has been a leader in outperformance for a long, long time, basically since 0809. And it's possible that we need to pass the baton to other areas of the globe. And some of those areas could very well start to outperform as well. So I've been really impressed with the robust price activity that we've seen there out of EFA. So keep your eye on that one. Let's go ahead and take a look now at our sectors here in the United States. This will be chart 5C. And as this pulls up here, we've got a clean sweep. It's all green all the way across the board. You love to see it if you're bullish. And so very nice move there. And, some of them obviously look better than others, as is the case pretty much always. So similar to when I was with you last week, I will reiterate that, my eye still sees technology as being our leader of this market. That's your chart in the upper right-hand corner. Communications just to the left of it also, I think, is a very strong place in the market at this moment. And then you're starting to see a couple of those areas down below, like healthcare and staples, really show some oomph to the upside there as well. People don't talk about it, but the staples are at multi-month highs right now, right? I think in a lot of people's minds, the staples are still stuck in this downtrend from a month ago. That's not the case. We're literally at the highest price on a closing price basis on XLP going back over the last 3 months here. So that downtrend got unwound in a hurry. And many of those stocks, your Coca-Colas and your Pepsis and your Hershey's of the world, are rocking it to the upside. And then over here in healthcare, I talked about Novo Nordisk here a moment ago, but they're certainly not alone. There are tons of healthcare companies that look strong out there here all of a sudden once again as well. So, those two don't have the consistent uptrend that we have out of technology and communications, but who knows, maybe this is the start of something big out of healthcare and staples, and not a lot of people are necessarily paying attention to that at the moment. In terms of today's bigger winners, it looks like communications had a good day, but it does look like discretionary nudged them by a small margin as being the best performer of the day. And I suppose that makes sense as well because of what we looked at on the heat map there earlier, where, of course, we had Amazon as a key discretionary stock lighting the world on fire, up over 4.5% here today. And of course, other stocks in discretionary like McDonald's hitting all-time highs. So that bodes well for XLY in general. It was up 2.21% today, but communications barely missed that. They were also up over 2%, in that case 2.08%. In terms of who our laggards were today, there was only one sector that was down today, and that was real estate. It was down 0.32% today. Utilities basically closed flat, and so it was a laggard on a relative basis there as well. All right, let's go ahead and now get into our trade application example. Before we head out of this 12 grid view, I would just point your attention to the financials. I've kind of brought this up a couple of times in the presentation already, but just so you can see it with your own two eyes. Notice that financials have not had a snapback rally over the last month, the way that we've seen in a lot of other areas, including healthcare and staples. Look at those huge moves off those lows in mid-March down below. And then look at where financials were in mid-March and look at the move it's had. It's been much more muted. It's gone up a little bit, but considering how much it lost in the month before that, it's got a lot of work to do. So when you look at this chart, you would say this is still one of our lagging areas of the market. you can see that it still has kind of a red to transitioning to yellow moving average at this moment. So it's making an attempt to get above that moving average, but this is the first time it's had that opportunity, whereas many of these other sectors have crossed well above their moving average weeks ago. So that goes to show that the financials are a relative laggard at this moment. And so that plays a role in the trade application example I did for tonight's video. So let's pull up a swing trading chart here, and I'm going to pull up ticker symbol ALL. This is Allstate. Of course, you're in good hands with Allstate in most cases, but perhaps in this situation, that won't be the case, as I've chose to do a bearish trade on this one. And the reason for that is it woefully underperformed the market today. Again, we had a great day in the stock market, right? 77% of stocks were up. Many of them were up 2, 3, 4, 5%, that big movements. And then here's Allstate, down 1.7% today. A bad day for it, even if the market were down, let alone when the market was roaring higher. So not a great look to it when that happens. This is actually its third day in a row to the downside. You can see that we are now back below the falling 30-day moving average. Notice the moving average color is red at this point, so that's more of a bearish feature. You can also see that this stock is underperforming the S&P 500, not just today, but over the 3 months of this chart, with that S&P 500 dotted line up above there and this company's price candles down below here. In addition to that, we have a little bit of a bearish near-term divergence signal, where you have a peak in the bearish, or I'm sorry, in the near-term line down below here on April 3rd, and then you have a follow-up peak here on April 10th, where this peak is lower than this peak over here. So you saw lower highs on the underlying indicator at a time when the price candles were showing in advance. Here is point number 1, and here is point number 2. So price went up at a time when there was a deterioration in the underlying indicator. And sometimes that's giving you an advance notice that not all is well with this situation. And today was case in point there. Because remember that bearish near-term divergence would have existed before today. But today was the aftermath of that and was showing us what sort of power is possible there to have this stock down 1.7% on such a robust bullish day for the overall market. You'll also notice all of these performance labels up at the top of the chart are red across the board, and what that means is those are negative performances in all of those time periods. So this is not just some sort of a recent phenomenon. This is a company that has not been able to get out of its own way from a price perspective here for the entirety of the last year. So what I opted to do in today's case was keep it simple. I just sold short this company in the stock market. So this is not an options trade in this case. I actually was investigating a number of trade candidates here today. It was a little bit more challenging for me today because we're about to enter into earnings season, and that provides a few more hiccups that are oftentimes not ideal. This one does have earnings as well, but it's not until May 3rd, so that gives us about 3 weeks to be in this trade. So I wanted to do something that was a little bit more short-term in nature. So what I simply did was I short sold this. I put our stop loss above the price candle of yesterday, and then that would push us for a 1-for-1 reward risk relationship slightly above 110 down below is what we're kind of shooting for. So stop loss above yesterday's high. Our target price would be down here just a skosh above 110. We're risking just as much as we are hoping to gain in this case. So either it's basically like a coin flip. Either the stock keeps falling and we make money, or if it chooses to reverse and go higher, we will be stopped out. But I would imagine that one of those two things will happen between now and this earnings announcement because of how tight that stop loss will be. So that was part of the reason I opted to go with this one. And my apologies as well for those of you that are premium members. I got this sent out on Telegram later than I would prefer. I was already pushing it a little bit in terms of how late I got the trade done, but unfortunately, Telegram kind of stalled out on me right when I put the information in there, and it kept on spinning and spinning, so I had to shut down Telegram and restart it, and then finally I was able to get it to push through, and it did get through before the market closed, but only a couple of minutes. So again, normally I want to give you more time than that, so today was kind of an exception to that, but nonetheless, that was the idea behind this trade application here today. Okay, so hope you enjoyed the presentation. If you got value out of that knowledge with Allstate or the 12 grid analysis or what's going on with the US dollar and how that's reflective there in gold, or the risk appetite that we can glean from junk bonds and Bitcoin rallying, or whatever it was that you got out of tonight's presentation, I have one simple request out of you. It won't cost you a penny. It only takes you 5 seconds out of your time. Please click like for me there on Twitter. As long as we're up and over 100 likes by the time I'm scheduled to do the video again on Tuesday, I'll plan on doing another full-length video like this one that you're watching right now. On the other hand, if you prefer the shorter videos, then don't click like. And if we're under 100 likes, then I'll just plan to keep it to a nice and simple 15-minute version of the video, just simply focusing on the 4 main U.S. equity indices. Okay, so that's what I had for you here tonight. Hope you enjoy the rest of your evening and weekend as well. David should be back with you here tomorrow, but I'll see you all next week. So until then, best of success with your trades and your investments. Goodbye for now.